I'd like to introduce our speaker, Mike Carter, President of Carter Investment Services.
Good morning. This is Mike Carter, and I'm here today to talk to you a little bit about tax planning. Year-end tax planning is coming up, and the key to doing any tax planning for the end of the year is you have to start before we get to December 31st. There are a number of different things that folks will want to do in order to save money on their taxes and to actually plan it properly. This will be both for business owners and also for individuals. So let us begin. One of the first things that you want to consider when it comes to year-end tax planning is whether to sell property or securities or not to sell. A lot of this has got to do, and this will also be important as part of our conversation, is to know what your taxes may be in 2019. If you know that, hey, I'm going to take a hit in 2019, or I'm starting a new business in 2019, and I'll have a ton of expenses, maybe it's better to actually sell an appreciated asset in 2019 rather than 2018 if you're going to be in a lower tax bracket in 2019. So a lot of the planning that we're talking about doing is also having an idea of what 2019 will look like. If, on the other hand, you know that, hey, I'm due for a big raise later in 2019, maybe it's better to sell your things in 2018 and take your tax hit today when your bracket will be lower because I'm in a lower tax bracket with my income. The same thing would apply to a corporation or a business that is selling, buying or selling as well. One of the other changes that came with the new tax law, this actually started this year, is that itemizations, and this is more of an individual thing, on taxes has been not necessarily completely eliminated, but it has definitely been pushed as a lesser priority for folks. Home equity interest is no longer deductible. For folks with larger homes, mortgage interest is only limited to the first $750,000 worth of debt. Some of the thresholds, particularly for medical, have been bumped higher. The threshold for actually the deduction that you get as a person on that front page of your 1040, how much you can write off of yourself, has actually been raised. So the individual deductions are limited as far as where we're going from the tax purposes. So that's a change that you need to be aware of. Geez, I'm going to write this off, I'm going to write that off. Well, a lot of those have sort of been phased out, or with the individual exemptions, they no longer apply. Using credit wisely. Let's talk about that in a couple of different veins. One, using a credit card to pay your expenses before the end of the year. Again, we're going whether we should pay my expenses the end of this year because my income's higher, or do I push my expenses into 2019 because my income will be higher in 2019 and I'll need the deductions then. While some of those individual deductions have gone away with the businesses, this is still a huge thing because you're writing it off against your business income. You can actually use your credit card even if you haven't used the services or gotten the deductions, where you're actually using them. You can use your credit card to pay for them now, because you paid for them in 2018, it counts as a deduction in 2018. So, using your credit wisely would be a matter of whether or not I can actually, I don't have the cash to pay that right now, but I do have some room on my credit card, let me do it now for the tax planning purposes. Same thing with, actually it's called bunching your expenses. And this is, whether or not you want to, put discriminatory medical expenses or charitable contributions into this year or next when it will do you the most tax good. And that might be something where you're bunching them all together. So that's another thing that you want to actually keep an eye on, particularly as you get towards the end of the year. But again, a lot of this is planning on what's my income going to be like next year. This year's income tax brackets will be the same in 2019. So we don't have a change like we did last year when the income tax brackets actually went down. So you don't have to worry about, geez, what are my tax brackets going to be? They'll be be the same for 2019 as they are for 2018. But the thing is that you want to make sure that what you're doing is fiscally sound. We do have some expired provisions. Now, this is the end of 2016. It's just a reminder that these have gone away. We do have, again, those above-the-line deductions for qualified tuition and fees. We no longer have the exclusion of the discharge of indebtedness on principal residence, which is a big way of saying if you short sell your home, that those exclusions that people would actually get a benefit from when the economy was bad 10 years ago and they were brought in by the government are actually sunsetting and have already sunsetted. So this will not be something you'll be able to enjoy going forward. Let's talk a little bit about your health future. This has got a lot more to do with how do you spend money that you actually are working towards for your health as opposed to necessarily taxes. Part of this is, if your employer offers a flexible spending account that you've been contributing to throughout the year because you have a high deductible plan, let's say, you need to spend down that money by the end of the year. I believe you can only roll over $500 at the end of the year. So if you have $1,000 in that account, you need to spend the other $500 down. Also, there's health savings account contributions. I like to bring this up, one, because we want to make sure that you're getting the best taxes for it. You can actually make your health savings contribution before the end of the year and max it out. So if you've only been putting $50 away and, geez, I'd like to get a bigger tax break, well, now you can actually put into the max before the end of the year to get your tax break. Coincidentally enough, the Las Vegas Metro Chamber's new group health plan for chamber members has plans that will also work with the health spending account or the health savings account and also a flexible savings account. So the new chamber plan actually works with these as well. Again, with both of those, though, you want to make sure that you're checking your spending or spending down what you've actually got. Sort of counterintuitive to do both, but if you've got both of those things rolling, then you want to make sure that you're actually applying it to your specific situation. Let us talk about business owners for a minute here. What we're looking at when we're talking about buying or selling, again, this is that timing thing. Are we buying this year? Are we selling this year? What we're looking at with capital improvements is not just buying, but also upgrading. If you're fixing something, if you're putting money into it, you can actually get a tax deduction this year. But do I wait till January 1st because, gosh, next year is when things are really going to roll. We opened the business this year. Things are going well, but we had a lot of expenses in 2018. So we don't need to really worry about having a lot of tax write-offs for the business. So maybe we wait until the first week of January to run down, and whether it's buying a work truck or buying a tower or crane or upgrading your computer systems, whatever it may be, you want to make sure that you're planning it so that you're getting all of the tax deductions that you can. Last thing you want to do is to go into 2018 with a ton of tax deductions, and then because you spent money in December, you don't have those tax deductions to write off against a higher income in 2019. We do have a higher depreciation deduction than we did before. You'll want to make sure that when you're talking about things like depreciation, this is definitely a tax discussion to have with your accountant or your CPA. Depreciation simply means that when you buy something that is used for a commercial purpose, the government actually allows you to discount the value of that product and you get tax money back for it. So there's deductions on that. They did change in the 2018 tax year. And so you'll definitely want to talk to your accountant and make sure that you're getting the most out of what you're actually doing for your business. There's a bonus, and that's where the bonus comes in on the depreciation deduction. And again, that's relatively new, so you definitely want to talk to your tax person about that. For individuals, again, required minimum distributions. This is for IRAs. This will be for your 401k money once you turn 70 and a half. So this is important. It's also important if you've inherited an IRA. If your folks passed away and now, gee, that's my IRA, but you left it in there because you didn't want to take all the tax hit this year. Well, there is a required minimum distribution on this. So this is not just for people who are over 70 and a half and retired. It's also if you inherit everything. In the first year, you can actually take your required minimum distribution before the end of the year. You can push it into 2019 because they give you a range of time to take that first required minimum distribution. If you retired this year and your income is much higher this year than it will be next year when you're living on your retirement and you're also on Social Security, maybe it's better to wait to take that required minimum distribution into 2019. And that way you don't have to pay the taxes till then. Make sure that you take your required minimum distribution every year after before the end of the year. You may not want to pay the taxes on it. If you're in a 25% tax bracket, it's like, wow, they're taking 25 cents for every dollar that I get. I'm only getting 75 cents on the dollar. The penalty for not taking your required minimum distribution is 50%. We don't have any 50% tax brackets, so that penalty is always going to be higher than the tax bracket that you take the money out of. So make sure that you take your required minimum distribution before the end of the year. My suggestion is to never wait till December to do it, just in case you run out of time. The last thing you want to do is be December 28th and, hey, can we get this done? No, because the holiday falls on a weekend this year and you're out of time. So that's something you'll actually want to plan, whether it's in October or November, to make sure that you're actually taking your required minimum distribution out of your IRA account to avoid the tax penalty. Let's talk a minute about estate and gift tax changes. Now, the exemption for estates with, this is a married couple, is $11.2 million. For a single person, it's half of that. This is also indexed for inflation. This started out at $10 million and it will go up every year. All that means is that when you die and your children inherit your estate, if you're worth less than $11.2 million, there is no federal inheritance tax. For those of us here in the great state of Nevada, we are one of the few states that has absolutely no inheritance tax. If your residence is in California, you do have an inheritance tax. So for those folks who may be doing business here in Nevada, but they live in a different state, you'll need to make sure that you're paying attention to what state that you're in, to make sure that if you die, that your children, that you plan for the inheritance tax that may apply to where you're at. There's also a gift exclusion, which means that when you, and we'll bring it up right now, we have both of the lotteries are at a very high level right now. One of them goes off today, one of them goes off tomorrow, Powerball and the Mega Millions. You're like, wow, I'm going to gift my friends $1 million if I win all of that money. What you have to understand is that you'll end up paying a gift tax to the federal government over anything above $15,000. Doesn't mean you can't get that money to your friends. It means you need to do some planning before you do so. And so make sure that what you're doing with your planning is that following what the letter of the law is. Estate planning is also more than about reducing taxes. You want to make sure that your documents are updated. You want to make sure that your insurance is correctly handled. Part of estate planning is privacy. You also want to make sure that your assets are protected, not just with your estate planning, but also with any investment planning that you're doing. You'll always want to talk to a well-qualified estate planning attorney when you do this. I would not suggest that you talk to your corporate attorney unless they have a specialty in estate planning. Always make sure that you're talking to an expert, and they'll help guide you through doing estate taxes and making sure that your estate is set up properly. A great time to review this is when you're reviewing everything else at the end of the year. If you've had any changes during the year, you'll want to make sure that you address that. If you've gotten married, if you've gotten divorced, if your children are now 18, a lot of times that were older, maybe they've graduated college, you'll want to make sure that your estate Your beneficiary planning, both with your retirement plans and also your life insurance, is also up to date. I've sat with many folks where we looked at a life insurance policy, and I'm sitting with a husband and wife, and it turns out the ex-wife is still the beneficiary on the life insurance policy. That's never a great conversation to have. So you'll want to make sure that you actually do some planning with that as well. And a great time is the end of the year when you're planning everything else, including your taxes. Another thing that you'll want to consider is, are there any other tax incentives for me to be able to look at? There are some specialized tax incentives. Typically, your accountant doesn't always hit those. There are things that the government's giving you money back on, whether it's
The conference has been muted. The conference has been muted.
Whether it's buying commercial property, whether you're getting tax credits for hiring employees, did you pay too much in your property tax, which is a tax we have here in Nevada? Are you getting money back from the government for your research and development that you do? There is a lot of different tax planning that you can do. You'll want to talk to a specialist with this, somebody who helps with specialized tax incentives. This is great if you end up getting a tax bill. Your accountant talks to you in March and says, wow, we are paying, and hands you a tax bill and you've got to cut a check for a lot of money. You're like, well, how can I get this reduced? Or how can I, mitigate what this is going to cost me? There's a lot of specialized tax incentives out there the federal government's offering. Essentially, what the government's doing is there's a lot of tax money sitting on the table that people are not taking advantage of. You'll want to make sure that you're taking advantage of it. Now, this is something that you can absolutely do before the end of the year. But you can also do it throughout the year. A lot of these tax advantages are things that we can, at the end of the year, we can just take advantage of this tax planning. But it's also things that you'll want to consider throughout the year. A lot of folks' end-of-year tax planning isn't always necessarily January 31st. Maybe it's April 15th. Maybe we close our books on June 30th of the year, not on December 31st. Maybe I got an extension on my taxes and it's September 15th or October 15th that I have to do my planning for. The government does allow a lot of extensions, just like they allow some of those extensions to actually do your taxes. Some of those extensions apply to the money that you're actually paying into them as well, whether it's on retirement plans or things of that nature. And now, let us sort of wrap things up. We're not going to make this a long presentation today. The key thing is that when you're talking about year-end tax planning, you've got to do it. Lots of folks talk about things and they go, okay, great, maybe I should do this planning or that planning. Well, particularly with year-end tax planning, there's a lot of things that happen at year-end, but you need to plan them before the end of the year. Retirement planning is similar to that. If you have you want to do a simple IRA for your business, you actually need to be, it needs to be in place already now that we're here halfway through October in order to start to get deductions here in 2018. Same thing applies to your 401k. You've got time until April 15th to make a contribution to your IRA or your Roth IRA. If you're doing a SEP IRA, you actually have time to contribute to that until the extension at the end of the year for businesses. But an awful lot of these things happen December 31st, and you want to be aware of that. Sit down every year and talk, whether it's to the folks that you work with, your board of directors, the other business folks in your business, or whether it's individually and it's you and your spouse or you and your significant other, and make sure that you plan your financial future every year. There's statistics and they bear it out. People spend a lot more time every year planning out the vacation that they're going to take that year than they do their future, particularly their financial future. You want to involve a number of different professionals in the planning. You want to make sure that your financial advisor is in here, your insurance agent, talk to your accountant, talk to a business consultant. And you also want to make sure that you're also talking to that estate planning attorney. A lot of times what the best thing to do is make sure that you have a team that's actually working for you doing this and that these folks also talk to each other. So planning for your future is important. You want to make sure that you're doing it every year. It's a lot less of a problem to actually get an oil change every time you need one than it is to wait, not do the planning, and then end up having to replace your engine in 3 years. And that's really what planning every year does for you. It actually allows you to get that oil change done and give you the opportunity to make sure that your financial future is set and that things will happen the way you want them to, as opposed to letting the future dictate what ends up happening to you. Thank you very much for your time. Again, my name is Mike Carter. I'm president of Carter Investment Services, and I help folks with their insurance. I do business consulting on specialized tax incentives, and I also help folks with their retirement planning.
Thank you, Mike. Are there any questions? If you are joining us on the phone and web, you can ask a question by typing it into the chat feature on the bottom left corner of your screen. If you are joining us by phone only, you can press *7 on your phone to unmute your line. Once you have asked your question, we will remute your line so that everyone on the call can hear the answer. Well, thank you, Mike, for sharing your know-how to end of the year tax planning.
Thank you, Lauren.
As a reminder, there'll be no Chamber University next week as we celebrate Nevada Day. Tune in November 2nd where we discuss the benefits of telemedicine. Have a great day.